Hey guys, I hope you're having an awesome day. My name is hamishwhodder and we are back with another episode of the YouTube stock portfolio. This is episode 10 and today we're going to be talking about the margin of safety. So over the past few episodes, if you haven't seen, we've sort of been going through my valuation process, which comes down to four key areas. The first is circle of competence, meaning that the businesses that you're investing in need to be well within your ability to understand the business. You need to be able to understand how it makes money, how it spends its money, how it invests its money, and sort of the macro environments that your business operates in and the factors that influence its profitability and that sort of thing. The second thing is that the business needs to have a wide moat, which is a long-term competitive advantage. That means that it's going to thrive in its industry and continue to be successful over the next 10 or more years. The third thing was that we need a management team in charge of the business that has skill and integrity. We first had a look at the skill component where we assessed how well they were investing within the business, making internal investments, as well as how successful they've been at managing their debt within the business. And then we needed to look at the management integrity, which is what we did last week in last week's episode, episode 9. We had a look at how we can determine whether or not the people in charge how can we determine whether or not their values are aligned with our values and that they are going to be honest and transparent to us through the conference calls and the letters to the shareholders and all of that stuff. And then that leads us into the last component, which is the valuation, where we actually calculate what we think the price of a stock will be at in 5 or 10 years' time, and then we discount that back. And this component is called the margin of safety. And I'm going to talk about what a margin of safety is, why it's called that, why do we use it, and then I'm also going to talk about what the best way to approach stock valuation is, because I don't see a lot of people talking about this, but it is very, very important in eliminating your personal bias and stopping you from sort of just falling into the confirmation bias trap where you find a stock that you like and you make the valuation. Well, I'm going to get into it, so I'll save that component for a bit later. And then, of course, lastly, we've got the two stocks that I think we may make an investment in, and we're going to go through and do a valuation of Google and Apple, and we'll come up with a distinct price that I think we can pay based on my valuation. And then, depending on what the prices are, if they're way off, we might I'm not sure what we're going to do. For the sake of the series, we might just make some investments, make some smaller investments, because I'm not really sure when. Because essentially, how my strategy works is that I'm waiting until there's a significant pullback in the market where the market prices are vastly underrepresenting the ability of the company, and that's just not the case right now. We've had a few days of pullbacks and a few days of down. However, we really haven't seen these stocks fall 20, 30, or 40%, which is what is required to get this margin of safety in order to buy these companies at a valuation where you're almost guaranteed to make a massive return on these stocks. So that's what we're looking for. And we'll probably find is that when we do our valuations of these companies, their prices will be far from their current price. Their buy price will be way below what their current price is, but we still may make some investments in these companies. And then when we do experience a recession, whether that's in a year, 6 months, or 2 years, then I can properly go through this and show you how you can make really strong investments in these companies and be almost certain to make money in the stock market. Because you can make a lot of money in stocks like Apple and Google at the current prices, but it's just a little bit riskier because if they underperform what the expectation is, because they at the moment everything is priced to really high expectations, if they underperform that, you're not going to make the return that you want. And that is completely different when we're in a recession and stock prices are slashed at 50% off or 40% off. But yeah, these stocks just become a lot more attractive when we're in a recession because, like I've just said, their prices are slashed significantly, but their long-term performance and the core of the business doesn't really change during a recession. So all it does is reduce the price, and where the stock is going to be in 10 or 15 years doesn't really change. So that just increases the return that you can make on a stock over that period. So that's what we're going to get into for today's episode. If you do enjoy, make sure you leave a like and let me know your thoughts down in the comments section below. Subscribe if you haven't already. For now, let's jump into it. All right, so let's just start off by talking about what is a margin of safety. So if you haven't heard the term before, what do I even mean when I say margin of safety? So essentially what we're talking about here is we're talking about when we're valuing stocks, we're talking about buying them below their fair value. Now, you might also not know what fair value is, but we'll get into that. But essentially what we're going to do is we're calculating a value that we think is fair for the performance of the business over the next 10 years. So depending on how they perform and depending on what return we want to make, we can come up with a price that is a value, an intrinsic value of the company that we think it's worth, how much we think the company is worth. And what I mean by margin of safety is that we want to buy these businesses at 50% of their fair value. And we'll get into why that is. But essentially what we want to do is we want to calculate the fair value, and then we want to divide the fair value by 2 so that we're only paying 50%. So we're paying a 50% discount to what we think the company is actually worth. So I'll just go briefly through what fair value is, and then later on when we do our valuation of Google and Apple, I'll show you exactly how you can use it and do it yourself, but you can easily do this also in my spreadsheet. So if you want access to that, just grab it, first link in the description below. It's completely free and it does these calculations for you, so that can save you a lot of time. I do that, it saves me a lot of time. But if you want to know what the actual formula is, so I've got it on screen here, and basically what we've got is the first component is FPE, which is forward PE, and that basically is the PE ratio in 10 or 5 years time, whenever we're going to be selling this stock. The second thing we need is forward earnings per share, which is the earnings per share in 5 or 10 years time when we're going to be selling this stock. So basically that first component of the formula is the future price, because if we have the current EPS, the current earnings, and we times it by the current PE ratio, the multiple on their earnings, then that gives us the current price. So in the same way, what we can do is we can calculate the future PE ratio. So the PE ratio in 10 years time, we can then calculate what the company will be earning in 10 years time. And if we times those two together, we get an estimate for a price that we think the stock will be at in 10 years time. Then we want to divide it by this formula here, which is 1 plus R to the power of N. R in this case is our personal required rate of return. So whatever return we want to make each and every year over the next 5 or 10 years. Personally, I always use 15% because basically if you just invest in index funds, you can get 10%, 8 to 10% pretty easily. So it's not worth it to do all this effort in analyzing individual businesses if you're just going to use an R that is 8 to 10%. You can just do that by investing in index funds. And I just pick a number that's a little bit above it so that it's worth the effort of going to the effort of investigating all these companies and analyzing them over a few weeks and that sort of thing. And it's not too ridiculous that you're never going to find an investment. And then the end component is that how many years we're going to be looking at. So if we're going to look 5 years into the future, this forward EPS will be the EPS in 5 years time. This forward PE will be the PE ratio in 5 years time, and this N here will be a number 5. So generally I look 5 or 10 years out. It depends on how long the company's been around. Usually I look 10 years out. For most companies that I'm making big investments, I look 10 years out. If I'm looking to make a speculative investment on a newer company like Facebook or a company that doesn't have 10 years of data yet, I sometimes only look 5 years out. But that's really only if I'm doing a speculative play, so I'm not investing a large amount. So usually it's 10, and for Google and Apple, we'll both look 10 years out, so that we can look way beyond what most people are looking. Most people on Wall Street and fund managers and even retail investors, they're looking in the next couple of years, and it's really tough to make profit in the next couple of years, I think, because everyone's looking there and any profit has been squeezed away. So it's best to look out 5 to 10 years into the future beyond what everyone is looking at, and that's where you can find some real value. So that's what I like to do. And then at the bottom here, I've just got, once we've calculated the fair value, we times it by 50% or 0.5, and then that gives us our buy price, 50% of fair value. So then the next logical question would be, why do we use a margin of safety? Why don't we just buy them at fair value? If we've calculated a future growth rate, a future PE ratio, and then we've discounted it by our required rate of return, and we've come up with the value, the price that we could pay in order to get our return over the next 10 years, why don't we just pay that? And the reason for that is because we need to allow for errors in our valuation. And there's two main errors that you're going to make in this valuation, especially if you're starting out. You're going to make the estimates that you're going to guess. They're likely going to be way off because you're just not used to understanding how a business can operate and what a realistic growth rate is. But the two areas that you're likely going to make a mistake in is, firstly, you're going to overestimate the growth rate. So you might think that a company can grow at 15% when realistically they're only going to be able to do 8 to 10%. And the other way that you're going to overestimate is that PE ratio. So some companies, when they're in high growth, will have a PE ratio of 30 or 40 or even higher. And if you estimate that a company has that same PE in 10 years' time, you might be way off, because when the growth prospects of that company have started to go away, what you might find is that the market prices that stock a little bit cheaper in the 20 to 25 or maybe even the 15 PE rate range. So those are the two areas that you can make mistakes, and that's why we want to allow for a margin of safety. And I've just written here that when you're starting out, it is really, really important to allow for that 50% margin of safety, because as I said, you're going to be wrong in your growth rates and you're likely going to overestimate your growth rates. I know I did this and I still do this a lot. It's very hard to be conservative and come up with a number that is really accurate to what the company can achieve over the next 5 or 10 years. So that's basically why we use the margin of safety. So then I wanted to talk about what is the best ways to implement this strategy, because there's this thing called confirmation bias where you're going to impact the valuation that you come to if you don't use this approach. And I recommend everyone use this approach. And essentially what that is you want to try and not look at the price of the business until you've finished your valuation. Because if you look at the price first, what you'll do is you'll calculate a value, and if the value is nowhere near the current stock price, you're going to recalculate the value until it becomes close to the stock price. And that is not how you should approach this, because it means that you're trying to conform the valuation to the current market price. And basically what this whole method is trying to prove is that the price has nothing to do with the value of the company. It might be close to the value of the company a lot of the time, but there's nothing in the price that can tell you anything about how the business performs, especially during recessions when stock prices are at 50, 60% discounts. The stock price isn't going to tell you jack about what the actual company is doing. And I understand this can be really hard to do, because basically as soon as you look up a stock, the stock price comes up, and if you have a decent memory, then you're never going to forget the ballpark of where that stock price is. So to avoid this, what I do at least is, if I look up a stock and I know the stock price in the back of my head and I can't get rid of it, what I'll do is I'll value the whole company. So instead of looking at a forward earnings per share, I'll look at a forward net income, and I'll just come up and I'll times that net income by the PE ratio, and that will give me the market cap. So that'll give me a price for the entire company, and then I can just divide that by the number of shares to get to a price. And that way I'm not going to be persuaded by the current stock price, and I can just look at it as a whole business perspective. All right, so let's now go through and value Google and Apple, the two companies that we've got left on our list to invest in. And let's come up with a fair value and a price. And I'm going to do this through my spreadsheet because it's so much easier than doing it by calculator. You can do it by calculator. You can just go back and pause the video and copy the formula. It is a little bit tricky to do on computer because you've got to do a to the power of 10 or 5, and you might need to work out how to do that. But if you don't want to if you just want to avoid all of that, just use my spreadsheet. It's so much easier. So to use my spreadsheet, basically over the first on the side, we've got to enter in some info. So the first thing we need is the earnings per share for the trailing 12 months. That's what that TTM stands for. So we're going to do Google first. So we'll go over and we'll see what Google's trailing 12 months EPS is. So the trailing 12 months EPS is $23.16. So let's use that. The time frame we're going to look at over is 10 years. And then we need the current stock price, which is $1,095 per share. All right, so essentially on my spreadsheet, there's two different calculators. The first one is an auto buy zone calculator. And basically what I mean by that is it's automatically calculated the growth rate based on their long-term performance. And then there's a manual one where you can just pick your own growth rate. And I would always recommend that you use both, because the auto buy zone calculator can be misleading, especially if you haven't done the research and you're just sort of chucking in numbers. you're probably going to get it wrong a lot of the time. So if you don't know how to calculate an estimate for the growth, first you want to have a look at their long-term performance as a company. And for Google, you can see that they've grown earnings at 12% per year over the past 9 years or 10 years. And they've grown equity at 20%. And Warren Buffett and Phil Town, actually, they both say that equity growth, long-term equity growth, is the best indicator of future earnings per share growth. So we could use 20.61. But I always like to compare this to the analysts, and I like to see what the analysts think, just to make sure that we're not way off. So that you want to make sure that the analysts aren't estimating 10% and we're estimating 30% or something ridiculous like that. So you can see that for the next 5 years, the analysts think that it can achieve 16.5%. So that's quite a bit lower than that 20%. So as you can see, the analysts are estimating 16.5% over the next 5 years, and we were going to use 20% over 10 years. So that's vastly different, and I would always recommend being conservative. So I would always use that 15%. So let's use that 16.5%, but let's use that over 10 years. So if we put that in here, now I just realized that Google still has some periods where they took that one-time tax hit that I've spoken about a few times. If you want to hear me explain that, go back and watch my video on how to analyze stocks. I think I called it valuing Google or something like that. Just search Google in my videos and it'll come up. And I speak about how they took a one-time tax hit to bring money from offshore. So that's still impacting their EPS. So what I'm actually going to use is their forward EPS. So they've had 3 quarters. Their third quarter earnings just came out actually today. And their fourth quarter will come out in 3 months' time. So we can just use this as our current earnings. It's going to be 3 months behind. So we're going to be looking 3 months forward. So it is a bit more risky to use forward earnings, but it's not too far out into the future. So I'm not too worried about that. But it's probably a lot more accurate than the $23 per share that they have that's sort of warped by that tax hit. So let's change that to 39.56. And that gives us a little bit of a more accurate picture of Google's fair value and their buy price. So using 16.5% growth, and the PE ratio that my calculator uses is the 5-year average that you enter here. So you can change this to whatever you want. If we think that Google can have a 30 PE in 10 years time, then we can put that in there and that'll change the fair value over here. So if we go with a 30 PE, which is pretty high actually, I probably shouldn't use one that high, but we'll do it for this series so that we get somewhere near buy price. So with a 30 PE and a growth rate of 16.5%, that gives us a fair value of $1,350 per share, which is above the current stock price, but that means that the buy price is below the current stock price by quite a bit as well. The buy price would be $675, and the current price for Google is about $1,100 per share. So if we use a 20% growth rate and that 30 PE, we start to get pretty close to a buy price. We'd still need to see the stock fall, 200 out of 1,100. We need to see the stock fall another 18%. So it's got to fall quite a way, but that's kind of in the ballpark of what is possible over the next 3 or 6 months for this stock. So I think that this $908 buy price is probably a very good starting point. So this will be a point at which I might start to open a position if I was really confident in Google stock. I'd done all the background work. I'd looked at the business. I'd seen that they have a moat. They have a great management team, and I've come to this valuation. That would be my first entry point. And then from there, you want to become more and more conservative. So maybe after that, my next entry point is $700 per share. And after that, it's $500 per share. So you slowly want to become more and more conservative. And it doesn't mean that you're sort of flip-flopping on what the value is. All you're doing is that you're becoming more conservative, and the growth that the company has to produce in order for you to get a good return is shrinking, which means that you're more and more likely to make a high return the lower that the price falls. So it doesn't mean that you shouldn't have bought in earlier. If you buy at 900 and then it falls to 500, it doesn't mean that you shouldn't have bought at 900. It just means that you're going to get a higher return on the shares that you're buying now. And it means that you want to average down your price as much as possible. So because you're never going to pick the bottom, you're never going to pick where the stock bottoms out and buy it there and then sell it right at the peak 10 years later. That's not realistic, and that's not going to happen. All you can do is calculate where you think the stock will be in 10 years time and sort of just try and buy at a price that's going to give you a satisfactory return. So I'll just put in our doc here that we've calculated that the fair value at our least conservative, so being fairly not conservative. I would be more conservative if I was doing this investing, but let's just be a little bit less conservative for the sake of the series. The fair value would be $1,800 per share, and the buy price would be $910. So that's the price we would be targeting in order to make an investment in this company. But let's go and have a look at Apple. So again, for Apple, we're going to need the EPS from the trailing 12 months. So we'll just go into Yahoo Finance and find that. So the EPS for Apple is $11.04. So we'll enter that in. We're going to look over 10 years, and the current stock price is $220 per share. So another thing you want to note, this is a bit more of an advanced tactic. You don't have to do this if you're starting out, but Apple pays a dividend of 1.3%. So that's what they're paying now, and they've been increasing that over time. So we could assume that over a 10-year period, if they keep increasing that dividend, we're going to make at least a 2% dividend each and every year over that period. So starting out the first few years, we might make like 1.3% or 1.5%, but as that increases over time, that'll increase beyond 2%. So it might go to 2.5%, 3%, 4%. And that way, over that 10-year period, the average will be 2%. So we could make an assumption that this company is going to be able to provide us a 2% dividend, which means that our required return can be reduced by 2% because we're going to get 2% from the dividend and we're going to get 13% from the stock price, and then altogether that's going to give us our 15% return. So this is a bit more of an advanced tactic. You don't have to do this when you're starting out, and if you don't know much about dividends, that's fine. But if you want to be a little bit more accurate, then you can do that. So you can see that the auto buy zone calculator has given us a growth estimate of 25%, which is really way too high. I recommend that you never estimate more than 20% per year over a 10-year period for any stock, because most businesses can't do it. Only the very, very best businesses produce 15+% returns over a 10-year period. And companies that have done it in the past are likely going to underperform that in the future. Maybe not by a lot, but it's unlikely that over a 20-year period, a company can produce 20% returns or something like that. But the auto buy zone calculator anyway has given us a fair value of $455, a buy price of $227, which means that it would just be a buy right now. However, if we have a look at their growth, you can see that those long-term growth numbers have not been representative of the company over the recent years. They've been slowing down quite a lot. And if we have a look at what the analysts say, we can see what they estimate. So the analysts are estimating 11.7%, so 12% basically. So we could use 12% in our calculator here, in our manual buy zone calculator, and that gives us a fair value of $150 per share and a buy price of $75 per share, which is a long way from where the stock price is right now. That's a really, really long way, in fact. What is that, like 60% drop in the stock price? Something we're probably not going to see, especially if Buffett continues to buy Apple. He's just going to be putting immense upward pressure on the stock. So, and I'm sure that if the stock price fell 20-30%, he would be buying a lot of stock, and that would keep the price from falling that far. But you can see that a company like Apple, it's really hard to get a 50% margin of safety, because we're going to have to assume something like 25% growth. Yeah, we're going to have to assume 25% growth each and every year for 10 years in order to get to a buy price. And this is using a PE ratio of 15. So we could increase this and use a PE ratio of 20. That could help us to get to a better valuation. Then the required growth rate would have to be 22%. But I think that is just way, way too high to assume. I would be much more comfortable estimating something like 12%, maybe even lower, 8 to 12%. And that means that the buy price isn't going to be until about $100 per share. So that's a long way off for Apple. All right, so that's where I'll leave today's episode. Next week, I'm going to go through the portfolio holdings and give you guys an update on that. I haven't done that in a while. And then we can talk further about these two companies. But from what we can see here, I think Google is a lot closer to being a buy, and that's simply because they've got much stronger growth prospects, I think, over the next 10 years compared to Apple. You might have a different opinion about that, and I'd love to hear your thoughts about that down in the comment section below. So let me know your thoughts down there. But I hope you guys enjoyed this episode. Make sure you leave a like and subscribe if you want to see more. These videos come out every single week, and I also have 2 other videos that come out every single week, usually an analysis video and then some kind of update video, whether that's my portfolio or stocks to buy or something like that. But I hope you guys have a great day, and I'll see you in the next one.